Welcome back. You're watching The Capital Point. I'm your host, Terryanne, Chebet. And of course, we're focusing on the tea industry, of course, a very, very important industry as an export earner in this country, and of course, providing a livelihood to more than 5 million Kenyans. And on the stock of the day, of course, we're looking at Williamson Tea, one of the oldest tea companies in Kenya, listed on the Nairobi Stock Exchange at the time. That was in 1971. And we'll just go into the revenue performance outlook, profitability, of course the dividend, and recommendations, of course, in terms of buying, selling or holding. I'm joined in studio by James Iraya Mwangi from the Harvest Terminal. Of course, the Harvest is Metropol's data terminal that provides industry and economic data across different industries and companies. Let's first look at the shareholding. James, what's the shareholding like if we look at foreign vis-a-vis the local shareholders?
Just like how generally NSE shareholding is, we have so many foreigners as compared to local. If we compare, if we now do it, we go granular to Williamson, foreigners actually control 62% of the shares. Local investors actually around 37%. That's if we include Kenyans and East African region. So just like how generally how NSE is, most people who are investing in Williamson Tea are not Kenyans.
Let's look at the financials in a little bit now in terms of revenue to start with, and the outlook in terms of revenue. Of course, in reflection to some of the numbers that we've seen, 2018 hasn't been such a great year for the tea industry. How does Williamson's numbers look in reference to that?
As much as we say 2018 has not been a good year, but according to Williamson, the revenues have been actually generally going up. If you actually compare 2015, where it was at 2.5 billion, to now in 2019, where it was at 3.35 billion, that's actually a 29% increment in revenue. So as much as you may find certain industries and sectors going down, this is actually a company in an industry that actually revenues are actually coming up, which is actually very surprising. Yes, but something else is that the cost of sales also have actually gone up. So now makes them they are no longer profitable. So even if we were to look at profit as of now, profit in 2015 was a negative. They made a loss of 295 million. As of 2019, they still made a loss of 200 million. So yes, revenue has gone up, but cost of sales, the reason now what is making them make that revenue, because that incurred to make the revenue has also increased. Now making them, they are not profitable.
And of course that does tie into the conversation I had with Omuga of Ngorongo, where he said the cost of production is actually going up year after year, yet the revenue is not actually increasing to the same rate as cost of sales. But the company has still been giving dividends.
Yes, and as much as maybe in 2015 they gave a dividend of 50 shillings. 2018 they gave of only 20 shillings. Sorry, 2015 they gave 40 shillings, and 2018, that was last year, they gave 20 shillings. So yes, they're giving dividend, but dividend has actually even gone down. Because you see, the company is not now making money, so this is money that's coming from their shareholders' retained earnings and shareholders' wealth to now give back as dividend.
Tell us a little bit about the profits, especially from an outlook perspective. There's a conversation earlier on the cyclical nature of the markets, the cyclical nature of the climate as well, and how that impacts, and that stakeholders generally are expecting 2020 to be a high-paying year for the tea industry. Do you see the same, when you look at the numbers for Williamson?
The industry and also this company per se has a going concern, that I would say that. And when it comes to revenue, the revenue will continue going up. As a matter of now, profit, I don't see them still making profit in 2020. Reason being because of cost of sales are going up. Unless there's a new strategy they come up in 2019 on how they may reduce the cost of sales. But what is happening is that as revenue goes up, the cost of sales goes up, the cost of sales will continues going up, and it now leads to them still making a loss. So I still don't foresee a profit in 2020.
How do you see that then impacting the performance of the stock itself?
Actually, if you actually compare now 2015 to 2018, that is 2018 to now, stock price, it was at 158 in 2018. That was in January. As of 30th of September, it was actually at its lowest at 138 shillings. So stock price is going down, which actually commemorates how actually the market is. But something that you would actually advise you is that this is the best time to buy.
Because it's on the bottom of the cycle.
Exactly.
Okay.
Because at the same time, we will even look at now other ratios now. For example, current ratio, that's now the ability to pay its short-term debts. This company is at its heights, it's actually at 2.98. So meaning meaning that the company is able to now even pay its debts. If you look at the return on equity, it's still at a positive, it's at 0.07, but it's still a positive. So meaning there's some money that's coming from every shareholder's wealth. If you look at return on assets, so meaning that the return on assets basically looks at for every 1 shilling of the asset, how much money is it bringing in terms of revenue. It's at 0.05. Yes, it's not a big number, but still a positive number. And then when you look at debt to equity ratio, this is 0.01. So meaning they're not relying on debt to service their operations, they're relying on shareholders' wealth. So this is a company that doesn't have so much debt. The revenues are increasing. Also at the same time, also share price is at its lowest, but at the same time, these are going concern. So,
so your recommendation is
yes,
it's the right time to buy.
It's a strong buy.
It's a strong stock. All right, and on that note, we wind up the Capital Point tonight. James, thank you so much for joining us. James Iraya Mwangi, head of the Harvest Data Terminal. The Harvest Data Terminal is Metropol's terminal that collects data on the economy, on companies, and on industries as well. My name is Terryanne Chebet. Thank you so much for keeping us company on the Capital Point. Let's talk business again next Wednesday.